If you are looking for healthy and strong income, I don't think you can go too far wrong with a business development company. Now, if you think about this simply as a company that's lending out funds to other companies to help them to grow, to help them to survive, they lend money out, they collect money in, and they pay their stockholders quite a bit of cash. Now, here, this is an alphabetic listing here, and we can see in terms of market yield, just here in the A's and the B's and the C's, we're looking at 9 to 11% yield down this market yield column here. Is this exceptional? It's pretty good. It's pretty good. Now, also over here, we have a column called NAV total return over 3 years. Now, this is the net asset value, the value of the assets of the company, and throwing into this and adding on to that also the value of the dividends that they're paying to the investors. So it's the gain in the overall value of the company plus dividends. And we can see here that it varies quite a bit over 3 years. Now, this is a total performance in 3 years. It's not an annualized performance. But here, just for example, we've got anything from 25 or 23% through to about 44% for 3 years. So we're talking about 7 to 8% per annum through to, 11, 12, 13% per annum returns for stockholders. Now, this is nice. So BDCs is definitely an area where I do like to invest. Now, if we scroll down here on the business development company universe, we see that there is, in fact, quite a wide range of these BDCs. Now, you'll see, for example, here in some cases, say for MS or Morgan Stanley direct lending or Nuveen Churchill direct lending, we've got a lot of NAs here where these are new companies, relatively new companies with very little actual performance here to look at. Now, one of the beautiful things about this website, this is free data and freely available, so you don't need a login or anything. We can go here and we can pull this up. If we look at the NAV total return for 3 years, we get a list. Now, in general, I would say that if you're looking for a good, strong business development company, you want one which is paying out not only a good market yield, but also returning money to the shareholders by increasing the value of the company with the net asset value. If net asset value goes up, the value of the stock should also go up. So if I'm sorting by net asset value total return here, we get a list of companies. Now here, this is about 20 companies, and we're looking at anywhere from 70% returns, which is very exceptional. Then you've got a sort of a cluster of performers here at around 50%. And then at the bottom of the screen here, about 20 companies down, we're down to the 24%, the net asset total return 3 years, which is cool. Now, if this is the mark of an excellent BDC, we have at the top here a couple of my favorite BDCs, and Main Street Capital, MAIN, is the one that I'm going to get into today. I don't currently have a shareholding. Explain a little bit more about why I don't hold the shares at the moment. But below this, we have Fidus Investment, which is one of my primary BDC holdings currently. And again, if you're looking at the net asset value total return, hopefully that begins to explain why. And also, as we compare the market yield through to the Main Street Capital market yield, again, it's got a higher yield, so it's providing me with more income at the moment. But of course, these numbers don't quite tell us everything we need to know. But let's look and dig into Main Street Capital a little bit more. So 6% market yield, this looks good. We know that there's some strong returns here, and we know that the price total return here has been strong over 3 years at 40%. So we're looking at quite a nice company. Now, the leverage ratio here, looking down the column, it appears to be more or less near the middle of the pack. It's got a relatively low level of portfolio debt. It's got a relatively low level of variable debt. And it also doesn't have a lot of high security or first lien loans here either, particularly compared to, say, Hercules Capital or, for example, Stellus Capital down here, or 6th Street Specialty Lending here, for example. This also enables us to jump in here and okay. It enables us to jump in here and understand a little bit more about what's going on. Now, in general, if we're looking at this particular chart, we're just looking at here in blue. And also what I want to see, though, is the strength of the underlying company. Now, that the strength or the fundamentals for the company, for me, is a look at the net asset value here, the value of the assets that the company holds. And if it's a fundamentally strong company, I want to see this value going up. And this is very much what I see here with Main Street Capital. Now, if I put price back on the chart here as well, we can see that the price tends to trade higher than the net asset value. That is, investors tend to want to pay more for this company than the net asset value. So it's trading in the next chart very much at this premium level. And we can see here that it's usually traded at about this 40 to 60% premium level. With the exception of down here at the COVID uncertainty era, where it dropped down, in fact, to a healthy discount, in fact. But of course, what a crazy time that was. Now, here is a little bit of the history here of the distributions, and I'm going to turn to another platform in a little bit too to try and understand a bit more. But it has here, for example, the regular dividends, and it also has some supplementary, or sometimes they're called special dividends, where the company is doing reasonably well. And they haven't necessarily increased the regular dividends too much, but while times are good, they'll pay out some of their additional benefit that they're gaining from their operations in terms of a supplemental dividend. The rationale or the reason for doing this is if the market turns not quite as good in the future, they should still be able to cover these regular dividends. So the way that Main Street Capital here is operating is this regular dividend, I think, will be very secure. I think they will keep on increasing it. And we can see here it was 24 cents in 2023, and now it's 24.5 cents a quarter. A small increase, yes, that's sure, but it's an increase, and it is a change in the right direction. Now, on top of that, we can also see these supplemental dividends, while times are good at the moment, have also been almost like another quarter of dividend payments on top of our regular dividends here every quarter, essentially. The dividends are being paid out every month, which is another reason why many people will like Main Street Capital. Now, scrolling all the way down on the bottom of this page, we get a good sense here of the exposure to different industries. Now, one of the things that I do like about Main Street Capital is it has what I think is a relatively nice diversification in terms of the products and the sectors here that they represent. So manufacturing, sort of 17%, consumer products and services, about 11%. For me, this is sort of giving a nice sort of quarter of their industry exposure in industries where I think there's some good sort of stability there, as opposed to, for example, IT software, which could be a bit more volatile in my mind. And the type of assets that they hold is that here, sort of 2/3 of their assets are first lien or senior secured loans. Now, if the company they are lending to has difficulty or runs into trouble or is financially challenged, it's these first lien senior secured loans that are probably going to be paid back before the common stockholders get anything back if the company collapses. So these are quite secure. Now, another beautiful thing here is if they're lending with manufacturing companies or lending to manufacturing companies, the manufacturing company probably has a lot of as well. So if the company ran into trouble, those assets would be liquidated. They would be sold, and the proceeds would then, first of all, go to the first lien senior secured holders here, such as Main Street Capital. So there's something here with a manufacturing company where we should see quite a good return on that investment that Main Street Capital has made. There's some common stock. Now, this is very powerful over time in terms of growing the value of the company, as well as some preferred stock and some other forms of equity as well. The beta, now it's a little bit less volatile than the S&P 500. Now, one of the things that I'll talk about in other videos is, yes, this looks less volatile, and this is very much under sort of normal circumstances. Under normal circumstances, this price chart isn't as volatile here in blue as the S&P 500. Now, the proviso here is under normal circumstances. If you hit these disaster periods here, the Main Street Capital and other BDCs can be much more volatile than the S&P or the wider stock market. They're much more sensitive to what's going on. So under normal circumstances, this price will be more stable. But when something goes awry in the market, we can see very, very large and very rapid drops in the price. I'm going to switch over now to another platform. This is the Koifin platform. And what I want to do here is I want to dig into Main Street Capital a little bit more. What I've got on this chart here is a chart of performance. I've got the S&P 500, O or Realty Income. I've got Main Street Capital and Ares Capital, one of the other large BDCs. Now, I want to put this on for 20 years. It's not going to be a perfect comparison because we can see here, for example, Main Street Capital was originated here only in 2000. Now, despite this limited history of performance, though, we can see that this total return chart, which is both prices, including dividends being reinvested, we can see that Main Street Capital, ARC, Ares Capital, and also Realty Income, one of my favorite, all three are doing better than the S&P 500. Now, I'm just going to shorten this time frame a little bit here, and we can see over a 5-year time frame that they have underperformed the S&P 500. Ares Capital and Main Street Capital have performed much better than Realty Income. Now, they've generally followed the same pattern here of a rapid increase after the COVID crash in the 2022 year, a little bit of a decrease sideways, and then in 2023, the sort of acceleration again into 2024. One of the challenges here, though, is this period, which we see here with the COVID crash. And here we can see, for example, took quite a dive, and we can see here in yellow, Main Street Capital took a very big dive. And you'll see that the S&P 500 took a relatively smaller dive. So Main Street Capital and ARC Capital here in green, they both went down. They went down hard. They went down fast. And that can be challenging if you're holding these companies. But generally, you can see that they have done very well, and they can, with time, keep up with the S&P 500 quite nicely as business development companies. Now, this is, of course, total returns. This is, of course, assuming that you reinvest your dividends. So what exactly does that look like? Well, let's dig into this a little bit more. Koifin as a platform, it has a good description here of the company. It's got a little bit of the profile here, some dividend information. Obviously, dividends are important. Now, if we look at the dividend chart here, we can sort of see visually that it's got a sort of an upwards trend here. We can see the occasional blip here with these special or supplementary dividends. Sometimes the blips are small. And it also gives us a dividend payout schedule here as well. And we see again these quarterly supplementary or special dividends being paid, much as we saw on the other platform. We can also see over time this dividend yield. Now, this is interesting because during periods here, during 2021, for example, we had a dividend yield of about 5.2%. And it's also increased at times up to almost 9 or 10%, and it currently runs at about 8%. And so it varies and fluctuates quite a bit. If you had bought it at the lowest possible point here in terms of prices, the money that you invested would now be returning 17.5% yield, which would have been quite amazing if you had the fortitude to invest at the bottom of the COVID crash. Koifin also enables us to look at the percentile rank here, which is one of my favorite charts and screens. It gives us a wide range of valuation multiples. And what this enables us to do is to look at a range of multiples that are going to be very specific to the particular company. In some companies, price to earnings multiple is going to be a very good gauge of valuation, and other companies, it's not. Other companies, this price to book value is probably going to be a better gauge. Now, for me, I like to look at the price to book, which is going to trade very similar to the price to NAV for a BDC. And we can see here it's 63% versus the 10-year history. So basically, it's in the middle of the pack here, not too. It's not red as in bad. It's not green as in good. It's just grey as in new. But if we also scroll further down, we can look at the margins and profitability. And here, for example, this is lighting up green. So they're doing well compared to the historical value. And it also gives us this comparison here over US and Canada financial stocks as well. So it's not, for example, performing too badly in terms of the price to book ratio compared to their peers, or compared to the wider market. So that's always good. Again, margins and profitability compared to their peers in the sector, it's doing well. And also compared to the wider stock markets in the USA and Canada, again, the margins and profitability are looking good. So I think you can certainly do a lot worse than this company. And as a very quick look as well, I want to look at the analyst estimates. And this is another area where I love this platform. Now, very quickly down here in the ratings tab, we've got a snapshot of what the analysts are saying about the company. One analyst suggests a strong buy, 5 are suggesting a hold. And we can see as well here, this line in black is the average analyst target, price target. In blue, we have the actual prices, and we can see, as a matter of fact, that the prices tend to trade quite close by to the analyst average targets. Now, the sort of the bands here, the highs and the lows are the analyst estimates for the price target, and again, very much compared to some other stocks, the Main Street Capital tends to trade within this band, and it tends to trade quite close to the average. Now, another really interesting way of using this chart might be to say, zooming in a bit, if the prices were down here and they're below the analyst targets, it may have been a good time to load up on the stock. And if prices are generally below the analyst average, it might be a really nice time or an encouraging time to buy. Where prices are above the target average, such as in these periods here or here, it probably is not the best time to load up. And when it's pretty much bang on like it is now, very, very much a time to hold, and probably not also a time to add to this stock. So a nice easy way here of trying to decide whether or not it is in fact a really nice time to add to Main Street Capital. Now, this is, as I said, one of the ways that I love to use this platform here on Koifin. It makes it easy to understand what's happening with the company, and dig into a lot of the analytics here. Now, let me know in the comment box down below, is Main Street Capital one of your core holdings? For me, this is a company that I absolutely love. At the moment, though, I'm finding the price to book ratio is just a little bit too high for me to add to the stock. And here as well, when we're looking at the sort of the price targets, Again, I think there's other value in the market that I'm looking for at the moment other than Main Street Capital, but can you go wrong holding this? I do not think so. This is in my opinion, a very strong, powerful long-term buy, and I think many people believe that. Do you disagree or do you agree? Let me know in the comments down below, and also consider watching another video of mine. If you think that this video has provided you with some value and some insight, do consider hitting subscribe, do hit the notification bell, and also look at this following video that YouTube thinks will be most valuable to you next. I'll see you soon, my friends.